Let's start off with a view on the kind of market activity we're seeing over in Zambia right now on the LUSE.
Yes, the Alishia index closed in the red yesterday. It closed at 3,713, down 19 points from the previous day. Most of that drop was due to a decline in the Standard Chartered Bank shares, which hit a 12-month low yesterday at 2 quarter turning way. The stock is now 38% down year to date, making it the worst performer on the Lusaka Stock Exchange.
Let's go through reasons behind the drop and why investors are pulling out in such a big way, Joseph.
Well, first of all, it is not a fundamental issue as such, as it continues to post strong numbers and increase its deposits year on year. Indeed, it has the best cost-to-income ratio of all the major banks in the country. What has really hit the stock, in my opinion, is the extra liquidity which has come by way of 2 bonus share issues the last 16 months. The second, of course, stands to comply with the Bank of Zambia capital requirements. Also, a lack of institutional interest in the stock has not helped as well. So the bids have really driven the price way down as small retail clients try to exit. A comparable bank, Zanaco, is only down about 9% year-to-date in comparison.
We're seeing these kind of movements, Joseph, in a context where there are low trading volumes that continue to persist. It continued in yesterday's session as well. What are you making of that and the kind of message it sends about the conviction of the movement we're seeing in stocks in either way?
Yeah, that's right. I mean, the all-share index is down 9% year-to-date, but on the back of low trading volumes. The trading continues actually to be concentrated in only a few stocks, namely Standard Chartered Bank, Zambia, TC, Zanaco, Zambia Sugar, and Lafarge. Of course, that is a concern, but in my discussions with local pension funds, they have mentioned to me that they believe they can get better yield from government bonds at the moment compared to equities, and they are allocating their funds with that in mind. Foreign inflows as well are also down in 2012 compared to previous years, and that really hasn't helped matters.
Of course, we've had a slew of company earnings come through nevertheless, and amongst those were the half-year numbers for Zamefa specifically. Take us through that and your interpretation of the numbers released.
Yeah, Metal Fabricators of Zambia, or Zamefa as they are known locally, reported their half-yearly results to June 30, 2012. As you know, they are majority owned by Phelps Dodge USA, and their main business is the manufacture and marketing of copper rods, telecom cables, and electrical conductors. They had a disappointing year last year to December 2011. Their net profit was 50% lower due to high exchange losses on net monetary liabilities denominated in US dollar and rand. The share price this year is the second worst performance, down 26%. So the market was really looking forward to their latest half-year update. Well, the turnover decreased during the year compared to the same period last year due to lower copper prices and lower volume sales in the domestic market. Turnover was 532 billion, down 6% from the same period last year. Earnings per share was up almost 30% to 52.74. Net exchange losses reduced during the period on the net monetary liabilities denominated in US dollar, which helped. Going forward, the company remains confident in managing the market challenges. But I think what will help Zamefa is the increased strong investments in the mining sector on the copper belt, as well as the construction sector, mainly in Lusaka. However, low-priced electric cables from Asia may continue to push margins down.